Big question is the president going to appoint a shadow Fed chair, right? There's a lot of talk that he's going to, already kind of semi-nominate someone, 9 months, 12 months in advance of when Powell steps down. That would be, I think, not warranted or not wise. I think it would create a really steep yield curve, right? People will be like, wait a minute, if we're going to kind of give up Fed independence or going to start pressuring that, right? And so I think Powell's done a really admirable job of just holding the line on Fed independence. The president can say whatever he wants. It's not going to affect what Powell's doing. The moment that gets questioned for real, and there's pressure on the Trump administration to actually do this, I think that could be very, very negative for markets. The dollar would sell off pretty tremendously. Yield curve would steepen. And so we'll see. It hasn't happened yet. Trump loves a lot of bluster, and we'll see if they go that next step. But I think that next step would be a really, from a macro trader, it would be easy to just sell more dollars and put on more yield curve steepeners. But I think it would be very bad for the country.
Why would, when I was a kid, Mike, we had a shadow Fed, of course, not in the White House, but Alan Meltzer at Carnegie Mellon put that shadow FOMC together, and they were quite vocal in their
way. He's going to take the Fed chair and do what the president says. Like they're going to define their independence. And so I have faith that we're going to continue to have independent central bank, and part of this is politics, right? President Trump is a master at politics, right? And so like him having someone to blame is a good thing from him from a political perspective.
Mike, what is the trade? You had mentioned a little earlier that, this doesn't bode well for the dollar, and the long bond could be under pressure as well. The 10-year, we're looking at it around 435 today. Realistically, where do you think it goes? And as a macro trader, would you go really short? Would you take that pain?
Listen, if I thought we were going to lose Fed independence yet, I would be limit short the dollar and limit short long bonds. The war is over. Israel stand down and have a prearranged agreement with Israel that, we'll take out that one facility, and then that's the end of the war, and say the same thing to Iran and try to declare peace at that point. That could be wildly bullish. It's an unbelievably tricky situation. If we just enter the war and it's protracted, categorically bearish. But if it's a one strike declare victory, it could, actually all kinds of geopolitical issues and internal issues, right, between tariffs and wars and this, the fights between, Trump's parade on one side and the No Kings parade on the other, right? All this discord, the stock market keeps chugging along. Partly that's because unemployment stays low and retail continues to be a participant. I think partly because of this giant data center build, right? This huge infrastructure AI build that's happening, which is adding incredible amounts to GDP. I've come to realize that despite bad government, we have such amazing capital markets and such an amazing entrepreneurial class that it's kind of holding off what feels to be all this, uncertainty. And so stocks don't feel like they want to go lower. Everyone I know has been underweight them, think they're overvalued. They trade like they want to go higher.
Mike, we only have about a minute or so left here, but we still want to ask you about crypto. We want to make sure.
And it's a really exciting time. We're going to get the stablecoin bill and then hopefully a market structure bill. And it's going to bring in TradeFi into this technology. We're going to see tokenized equities. We're going to see perpetual futures, which is a crypto idea, be brought into the US, both for crypto and for non-crypto. It's a different way of looking at derivatives. And so I think, what I'm thinking from our firm's perspective is we're going to partner with people. We're going to have white label solutions.
CPI report, core inflation was 0.13% month over month. The goods component was in deflation, which is affected by tariffs. And then if you look at core, the two biggest contributors were housing and auto insurance. That was 0.14. So outside of housing and auto insurance, we had deflation in the May CPI report. I don't think tariffs are going to cause housing prices to go up, nor is it going to cause auto insurance. So to me, the Fed is, I think, shifting to looking at expected tariffs, but not realizing the real driver of inflation. 75% of inflation since 2019 was housing and auto insurance. Those are both actually starting to cool.
So are we all, not we, you, three, all suggesting that the Fed, I think the professor already said as much, that the Fed should cut rates in July? Harvey, you first. It sounds like yes.
So what the Fed has said, and which I agree with, the Fed's saying, hey,
Get a job, it's much harder. So as Professor Siegel says, there's long and variable lags. There could be an accident where the Fed will have to panic. So I think that's something we have to watch in the incoming data.
When you say accident, what do you mean? On the long end of the curve, like rates go up too much? What do you mean?
No, I think that there could be a point where the Fed suddenly realizes the risks are actually to the downside for the economy weakening. And so the Fed will actually have to respond to an economy that they're strangulating and really fighting what they believe is a supply shock inflation. So I'm a little concerned that the Fed could be late if they continue to hold.
Adds to the uncertainty, the Fed's roadmap and the Middle East, you throw that into the mix too. We're not really sure what's going to happen there. What's your best idea now in light of all that?
best idea is still AI. AI has run, but it's still, if you're looking 12, 24, 36 months out, it's still that AI trade.
This says, no, they're giving you every reason, and they keep telling you and proving to you, including in the most recent earnings season, exactly why money should still go to those stocks.
Well, AI is very important, and certainly those companies, I think, will continue to prosper. But let's not forget about the AI users. And I think it's in the infancy of use to cut costs by regular firms that are not in technology. And I think in some ways tariffs might be one of the things that pushes them to more intensively use AI to cut costs. We saw during the pandemic, all of a sudden, people use Zoom. They saw, well, I don't have to have a business meeting,
Still really strong. The shock from April really hasn't affected things all that much. I think if you have that weakness, but we get some progress on trade and tariff, people will look through it. But if you're asking the question, are numbers going to be solid? Numbers will be solid.
Yeah, Tom, you agree with that?
I do. I mean, I think companies have proven many times over the last 5 years that they are incredibly resilient and adaptive. This is really the fifth shock that they've absorbed. I do think one of the consequences of sort of surviving COVID and fastest hikes in history and now this tariff shock is that investors are going to start to assign higher multiples to the companies that are succeeding.
Like, subscribe, and turn on notifications. Support the channel by liking this video, subscribing, and enabling post notifications for more content on crypto and digital assets. Check out our other videos and share your thoughts in the comments below. Your engagement helps with the YouTube algorithm and keeps the content coming. Thanks for your support. Enjoy the video.